Hello, welcome to this week's top news from the banking sector. I am Srinivasan. The Finance Minister Nirmala Sitharaman to review credit flows with PSB chiefs on May 11th, 2020. RBI gets a robust response to 10-year GSEC auction. Government borrowings to jump up to rupees 12 lakh crores for the fiscal 21. Second round of capital raising could be challenging for Yes Bank. Amend RBI Act for non-collateralized reverse repo, says SBI report EcoWrap. Asian Infrastructure Investment Bank offers $500 million for battle against COVID-19. SBI hikes floating rates on its housing loan. Supreme Court makes Sarfasi Act applicable to cooperative banks. And now for the news in detail. The Finance Minister, Nirmala Sitharaman, would be reviewing credit flows with public sector bank chiefs on May 11, 2020. The agenda of the Finance Minister is very easy to guess. It is to review the flow of credit into the economy from these banks, which would involve credit sanctions and disbursement since March 1st this year. She will also look into COVID-19 related sanctioned and pre-approved emergency credit and reassessment based additional working capital. Further, she will also look into the support given to NBFCs as well as to targeted lending of term repo operations, credit support to MSMEs, interest rate transmissions to borrowers, availment and deployment under TLTRO, and extension of moratorium of term loan installments and EMIs to the borrowers. The second news is RBI gets robust response to 10-year GSEC auction. RBI's auction of GSEC got a very good response thanks to the surfeit of liquidity in the market. The new 10-year benchmark government security, which carries a coupon of 5.79% maturing in 2030, received a bidding of 4.89 times the notified amount of 10,000 crores. RBI also exercised the green shoe option. At the auction of the government security maturing in 2022 and carrying 5.09% coupon, the RBI received bidding that was a whopping 6.81 times the notified amount of 3,000 crores. Here again, the RBI exercised the green shoe option of 2,000 crores. At the auction of the government security maturing in 2060, carrying 7.9% coupon, the RBI received bidding that was 3.79 times the notified amount of rupees 6,000 crores. Here again, it exercised the green shoe option of 2,000 crores. Now, this excess liquidity is driving down yields in government security market, with the yield on the existing 10-year benchmark going down below 6%. you all must be aware that bond yield and price move in the opposite direction. Now, government borrowings to jump up to rupees 12 lakh crore for the fiscal 21. The government's estimated gross market borrowing in the financial year 2020 and 21 will jump to 12 lakh crore against 7.80 lakh crore estimated in the budget on account of COVID-19 pandemic. The revised calendar will see government borrowing rupees 30,000 crore on an average every week in the remaining period of the first half of FY21 against 19 to 21,000 crores on an average as per the earlier calendar. The Reserve Bank of India, in consultation with the Government of India, reserves the right to exercise the green shoe option to retain additional subscription up to 2,000 crores each against one or more of the above security, which will be indicated in the auction notification. Now, higher borrowings are likely to push up the yields unless OMO, that is the open market operations, or other instruments are deployed by the RBI to absorb a part of higher issuance and crowd out borrowings by state governments and corporates. With ample liquidity in the banking system and the lack of demand for credit, this increased borrowing program will sail through. Second round of capital raising could be challenging for Yes Bank. We all know the story of the crisis hit Yes Bank and how it was bailed out by State Bank of India and a group of other investor banks. State Bank of India invested 6,050 crores, while seven other lenders invested 3,950 crores. ICICI Bank invested 1,000 crores, Axis Bank 600 crores, Bandhan Bank 300 crores, Federal Bank 300 crores, Kotak Mahindra Bank 500 crores, IDFC Bank 250 crores, and HDFC Bank 1,000 crores. The State Bank of India holds 48% in Yes Bank. ICICI and HDFC together hold 8%. Axis Bank holds 4.8%. Kotak Bank 3.6%, Bandhan Bank 2.4%, Federal Bank 1.9%, and IDFC Bank 1.7%. Now, the issues at stake: Yes Bank's capital ratio that managed to move above RBI's regulatory requirement after SBI and seven other lenders pumped in 10,000 crores into the bank have slipped down again below the critical threshold in March quarter. As of March 31st, the bank's CET, that is the Common Equity Tier 1 ratio, and Tier 1 capital ratio slipped to 6.3% as against regulatory requirement of 7.375% and 6.5% as against 8.875% respectively. This implies that the bank will have to take immediate steps to shore up capital to avoid RBI placing it under prompt corrective action. Understandably, all eyes are on SBI to rally around as it holds 48% in Yes Bank currently. Yes Bank needs capital not only to meet regulatory requirements but also to absorb losses in the current volatile environment. The management has stated that it intends to raise 10,000 to 12,000 crores immediately by June. This second round of capital raising, after the reluctant contribution by SBI and the others, will be an Herculean task, but critical to ensure the survival of the bank. There is now an urgent need for the bank to raise capital to first meet the regulatory requirement And based on Basel III figures, the bank immediately needs 5,000 crores of Tier 1 capital to meet regulatory norm. This aside, the bank will obviously need additional capital to absorb incremental losses on account of higher delinquencies and provisioning in the coming quarters. Understandably, all eyes are on SBI to rally around as it holds 48% in Yes Bank currently. But given that SBI's holding in the bank is already near the threshold limit of 49%, as laid down in the center's approved reconstruction scheme, other lenders and investors too will have to infuse capital to ensure that SBI's holding stays within the 49%. As per the reconstruction scheme, SBI and others were issued shares at rupees 10 per share, 2 rupees face value plus a premium of rupees 8. Yes Bank's current market price is 27. If new investors are issued shares at a steep discount to the market price, it could lead to a steeper dilution for the existing shareholders, depending on the quantum of capital they infuse. If the capital raising is done at near around market price levels, then the more critical question will be whether the new investors will be willing to pay high valuation for the crisis hit bank. Amend RBI Act for non-collateralized reverse repo, says the SBI report. State Bank of India's Economic Research Report, that is ECO-RAP, has given food for thought, giving its recommendations on reverse repo and LTRO, that is long-term repo operations. The report says that both these lending windows need to be non-collateralized since it will bring in multiple benefits to the market. You all may be knowing that in reverse repo, there is nothing but a purchase agreement of government securities. So, which means the collateral is a government security. And what SBI EcoWrap is telling is that we need to convert this into non-collateralized window. Now, since lending to RBI is riskless, this is the logic of SBI EcoWrap. Since lending to RBI is riskless, there is no need for GSECs as collateral security. Well, it makes sense. Instead, RBI could issue its own securities, as has been done in some other countries. The RBI could also come up with SDF, that is standing deposit facility, and could give a lower rate than the reverse repo. And currently, under the reverse repo rate, the government securities that are included for the purposes of computation of SLR. Now, by merely non-collateralizing reverse repo and also LTRO would mean that there will be a greater demand for government securities. This will also ensure lower supply of government securities, though through the issuance of CMBs, that is cash management bills. Absorption of additional surplus liquidity at a lower rate through SDF will also pull down the entire interest rate structure. EcoWrap further says that the current cap on reverse repo needs to be scrapped and SDF should be introduced. Well, certainly a very valid recommendation which the RBI needs to look into. The Asian Infrastructure Investment Bank offers 500 million US dollars for the battle against COVID-19. Beijing Bank, Asian Infrastructure Investment Bank, will offer $500 million loan to aid India's COVID-19 efforts. The financing will enable the government of India to scale up efforts to limit the transmission efforts and strengthen the health system to expand its response capacity and enhance preparedness to manage future outbreaks. It was created as a part of coordinated international response to counter COVID-19 crisis and has an initial size of 5 to 10 billion dollars to support all AIIB members urgent economic, financial and public health pressure and quick recovery from crisis. The project also supports the purchase of medical equipment, enhanced disease detection capabilities, and strengthened research. It is expected to address the needs of infected people, at risk populations, medical and emergency personnel, service providers at medical and testing facilities, as well as national and animal health agencies. SBI hikes floating rates on its housing loan. SBI has increased risk premium it charges over and above its external benchmark rate, that is EBR, by 20 basis points for floating rate home loans for salaried customers with effect from May 1st. While India's largest bank has kept its EBR steady at 7.05%, it has revised the markup on floating rate home loans upwards by 20 basis points. Meanwhile, SBI has also announced the reduction in its MCLR, that is marginal cost of funds based lending rate, by 15 basis points across all tenors with effect from May 10th. The 1 year MCLR will come down to 7.25% from 7.40%. Consequently, EMIs on eligible home loan accounts, which is linked to MCLR, will get cheaper by about 255 rupees for a 30-year loan of 25 lakhs. Supreme Court makes SARFAESI Act applicable to cooperative banks. With the Supreme Court ruling that the Securitisation and Reconstruction of Financial Assets and Enforcement of Security Interest Act is applicable to cooperative banks, these banks will be encouraged to pursue recoveries of long pending dues with renewed enthusiasm and reduce their non-performing assets. The judgment has come as a great relief for 1,540 urban cooperative banks, as a very large number of borrowers who were willful defaulters were taking advantage of the ambiguity in the interpretation of SARFAESI Act by various courts and were not returning the loan amount for years. The five-bench SE, comprising of Justices Arun Mishra, Indira Banerjee, Vineet Saran, M.R. Shah, and Aniruddha Bose, emphasized that the cooperative banks under the state legislation and multi-state cooperative banks are banks under Section 2(1)(c) of SARFAESI Act 2002. Recovery is an essential part of banking, and as such, the recovery procedure prescribed under Section 13 of the SARFAESI Act, a legislation relatable to Entry 45, List 1 of the 7th Schedule of the Constitution of India, is applicable, the court ruled. The Parliament has legislative competence under Entry 45 of List 1 of the 7th Schedule of the Constitution of India to provide additional procedures for recovery under Section 13 of SARFAESI Act 2002 with respect to cooperative banks. The provisions of Section 2(1)(c) 4A of SARFAESI Act 2002, adding ex abundanti cautela, which means out of abundant caution, a multi-state cooperative bank is not ultra-virus that is beyond the legal power, as well as notification dated January 20th, 2003, issued with respect to cooperative banks registered under the state legislation, the judgment said. So thank you very much. This is all for that this week. Stay safe, stay positive, take care. Bye bye.